Paints has proved that a strong brand is able to tide through the toughest of conditions. This has been proved time and again, quarter after quarter. So once again, in Q1, when we were faced with the challenge of the second wave, Asian Paints has managed to deliver a 106% decorative volume growth, which is no mean feat. Analysts were not expecting that number. They were expecting a much lower number. So the fact that they managed to beat it and how is something that largely all brokerages have given a thumbs up to. The one negative factor or the one thing that could perhaps drag Asian Paints is on the margin front, where it's coming much below expectations, but that's largely because the input cost inflation has been so strong. Yes, the company has taken price hikes, but it's not been enough to cover the extent of cost inflation that has been seen. But the other point over here is that many brokerages believe that these high costs are simply transitory. It's going to pass. The key concern here is valuations of Asian Paints, which is why most brokerages, or rather brokerages in general, have a very mixed stance towards Asian Paints. So look at Credit Suisse. They have maintained an outperform stance with their target price at 3,480 rupees. They know the very strong volumes despite the second wave of COVID, and they do say that the hit to the gross margins and concomitantly, of course, to the EBITDA margins is in all likelihood transient. They do cut their FY22 EPS estimates by 8%, but they increase their FY23 estimates by 2%, given the fact that they do expect that this input cost will come down in the subsequent years. They've also increased their target multiple to 72x in line with the average. ICICI Securities, meantime, does also note that the company does have a strong brand, they have a market leader position, and of course a robust balance sheet. This, according to them, justifies Asian Paints' premium valuation. It's been a consistent compounder as well, with stock price appreciating at a 31% CAGR over the last 5 years. Again, no mean feat. They say revenue and bottom line growth was ahead of estimates, but the EBITDA margins came in lower than expected. So they introduced their FY2024 estimates. They roll over their valuations on FY24 and maintain a buy on the stock. They value the stock at 3,665 rupees. That's 62 times the FY24 price to equity. Now, on the same valuation front, while ICICI believes that it is justified, MOTILAL OSWAL believes that it is this rich valuation, which is almost 70 times the one-year forward PE, that is preventing them from taking a more constructive call on the stock, and hence they have maintained a more somber neutral stance with a target at 3,070 rupees.